Today is Monday, June 14th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Steve Freed, Vice President of Grain Research at ADMIS, Alan Bush, ADM Investor Services Senior Financial Economist, and special guest Dan Basse, President of AgResource Company. Steve, let me start with you. Grain futures are sharply lower this morning. Why? And do you think prices will continue to slide lower?
I think the market, a couple of things. Number one, I think the market is looking at a 2-week weather outlook that is wet across the Midwest. And talking to our weather guy, he feels that some of these maps are too wet, that the tropical storm that's in the Gulf later this week will not provide moisture into the Midwest, and he kind of confines next week's rains into the Ohio River Valley area. So I think once the market realizes that, we might put some more weather premium on the marketplace. I also think that we're still living off the USDA's June numbers, in which they lowered the soybean crush and they raised the bean carryout, which was negative. And they didn't lower the corn, old crop or new crop carryouts as much as people thought. And I think that they eventually is going to have to raise demand and lower those carryouts. So I don't think this price slide will continue.
Dan, let me turn to you. What are your feelings about this latest price action? Market volatility is extreme. Will this continue?
You know, Kurt, I kind of think it will. I say that because as we look at the world's stock use ratios of major exporters of both corn, soybeans, and wheat, we're now sitting either at record lows or in the case of soybeans at a 24-year low, close to the record. So I think because of those record low stocks and because of the importance of the growing season and weather that Steve just mentioned, that this volatility is going to stay with us all the way through the end of summer. So strap yourselves in, maybe look at options or something like that in terms of being able to play these markets. But boy, it's going to be a volatile summer as we get into that month of July.
Steve, what's the latest on global grain demand, in particular China demand for U.S. grain exports? And Dan, you can think about that question as well.
Well, I think we're running kind of to the end of the old crop soybean and wheat exports, and looking ahead for new crop. We're still waiting for China to come in and buy beans. We think they're going to buy more beans from the U.S. than last year. We think that as far as old crop corn is concerned, China will ship the corn that's on the books. And I think that new crop, I think China is going to buy more corn next year from the U.S. than this year. But we just need them to come in and start buying. Domestic demand, especially from a crusher standpoint, is very strong. And I think the feedlot demand is also strong. So I think China needs things. I just think that they haven't started buying yet. And again, go back to the S&Ds. That demand on the export side is very important to bring carryouts down and eventually put prices higher.
Dan, what are your feelings about the current demand situation?
You know, Kurt, I would echo what Steve said. I would agree with all of that. I would point out to the community, the ADMIS community, that when we look at census exports, those exports that USDA has to use at the end of the crop year, they are running 124 million bushels above in soybeans and 153 million bushels above in corn from FGIS. That's those numbers we get on Monday. So with that in mind, I'm very comfortable talking about a 3 billion bushel corn export number for this crop year. And then I would pose the question, why aren't we going to be exporting that amount of corn next year when the Brazilian crop is done? So we think USDA is probably as much as 600 million bushels too low on their new crop corn export estimate. It'll take time to get there, but I would agree with Steve that going forward, demand looks really solid. Ethanol numbers this morning, or demand, if you will, margins for ethanol are quite high, 30 cents with the corn down move. So in my mind, we've got a very strong demand profile here as we look towards the end of summer.
Dan, interesting question for you. What should the U.S. grain industry use to best measure U.S. corn and soybean yield?
Well, I think each week now, Kurt, we're going to be thinking about where is the yield. So last week, a lot of us firms, including AgResource, dropped our corn yield. We're currently sitting at 177.5 versus USDA's 179.5 because of weather. So we took conditions, we take weather, and we kind of model it or mix it together. Some people incorporate satellite like Indigo or others. Now, they were talking about a 174.5 yield, and we'll have a measure. But I think as a broker or a trader, each week you need to kind of decipher where is the yield this week, where are we heading the week after. Now, if we start to get rain and cooler temperatures, as some of the models suggest, I'm still not buying into it. Like Steve, our guy, is looking for some rain in the Ohio Valley, but thinks that the western U.S. stays drier, that indeed we will see maybe some stabilization. But we think the top end is off the corn and soybean yield as now. We think this heat and dryness in the start that we've had has hurt populations. We think generally that yield numbers and condition ratings will be declining as we go forward for the next couple of weeks.
Steve, soybean oil, why have the futures dropped so dramatically, and do you feel this price action will continue?
I think there were a lot of rumors last week about the Biden administration maybe re-looking at some of the renewable fuel mandates and some of the waivers. And again, it's not confirmed. And I think that the market is oversold. But again, we're watching palm oil production might be exceeding demand, and concerned about India, maybe even China cooking oil demand. So I think the soybean oil market has been the leader and supportive of the bean market. It's also been the leader on the downside. And I think that 64 cents a pound is just too cheap for soybean oil.
Alan, I'm going to turn to you. The precious metal markets are lower today. What is the outlook?
Well, I think today that there has been some fear that with the Fed meeting this Wednesday, actually it's a two-day meeting, Tuesday and Wednesday, that the Fed may talk more about tapering. That would be tapering their asset purchase plan. So I think those concerns caused some long liquidation in the overnight trade and early this morning. But I think once that meeting is out of the way, traders will again center on Fed policy that still remains overall very accommodative. So once the meeting is out of the way, I think we can see the bull market resume in the precious metals.
So, Alan, interest rates and T-bonds, the 30-year T-bond yields have declined in recent weeks. What's your take on this?
Well, the fact that yields have declined at a time when there was so much inflation talk, that to me suggests that possibly the economy may not be growing as much as many analysts are anticipating. It also could be an indication that the rate of growth of inflation has peaked. And I think those are likely scenarios, and I think those are basically what's happening. So the fact that yields are declining when they should not suggests that the global economy may just not be quite as strong as many are anticipating.
Alan, one final question for you. What is your outlook for the stock index futures currently?
Well, I still have to be bullish on the indices. We did see a new record high last week in the S&P, some follow-through gains today to new record highs, but a little bit of a setback. So even when the Fed does taper, which I think will be later rather than sooner, there still will be plenty of accommodation left here in the U.S. and even overseas. So the trend is still higher. So I would have to say that the near-term outlook on stock index futures is still the same. I would look for higher prices.
I have one more question for Dan, and it has to do with biofuel. Dan, what is the Biden administration's policy, and what do you place the odds of the return of refiner waivers?
You know, Kirk, this administration wants to be green. It sees biofuels as a stepping stone to electrification. As we look at it, I think the oil industry and refining industry meets every week or almost every other week with the Biden administration, trying to cajole them into some kind of waiver policy once again. But if you go back to Biden's campaign speeches, if you go back and look at his platform at G7 in terms of climate change, I think it would be a very low odds that he will ever offer a waiver for a refiner relative to energy. So as we see it today, we think that was a somewhat errant story that was put out on Friday, and we think the odds are extremely low there'll be any change in biofuel policy from this administration going forward. Renewable biofuel investment is still going strong. You saw last week a competitor firm, we call them Cargill, was going to invest $300 million in their own plant. I think this signifies their confidence in what's coming in terms of biofuel policy.
Thank you all this morning. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.